for someone who's going to help us give a little bit more context as to what we should and can know about this, investors, they continue to be on edge over the health of the financial sector as concerns swell about the contagion risk from SVB and Credit Suisse's troubles. Let's bring in Devin Ryan, who is the JMP Securities, a Citizens Company Director of Financial Technology Research, for a read on the broader financial market here. I mean, if there is any way that the banks right now could assuage concerns that businesses, that consumers have, what would you be looking for them to say right now, Devin?
Hey, good morning, Brad. So just to take a step back, what's happened over the past week has obviously been unsettling. Trying to follow headlines day to day here is challenging. And so investors move to the sidelines to try to figure things out. But I think, banks and just financials more broadly need to, continue to be transparent around how they run their businesses and also kind of where they differ from some of these firms that are having issues. So if you look at Silicon Valley, which I don't cover, but if you look at their balance sheet, you can clearly see where the asset liability mismatch became an issue, and they effectively became liability sensitive. Most financials are actually asset sensitive. And so just over the last day or two here with interest rates coming down, that's been weighing on share prices, but that's okay because that's just more of an earnings dynamic than some broader contagion fear in our opinion. So I think it's really being transparent and obviously highlighting the strength, the safety, soundness of the business, and that's where we want to focus as an analyst. Those are the types of companies that will come out of this in a better spot. Obviously appreciating that we're not going back to normal in a day or two after such big steps were taken over the weekend and then the last few days here as well.
Well, and Devin, when we talk about Credit Suisse as well, I think the concern there is the counterparty risk, right? Who is on the other side of trades, et cetera, when it comes to Credit Suisse? For the companies that you cover, how much transparency do we have into that question?
Yeah. Hey, Julie. So, I feel good about at least the companies that I cover. They I think manage their counterparty exposures very closely. What we're talking about, just again, for all the banks in the balance sheets, like most of these issues are not new. And so, as analysts, we've been looking at talking to clients about a lot of these types of issues in the market for the past year or even longer in some cases. And so I think companies managing risk, managing exposures are doing even more than that. And so I feel good about counterpart exposure. However, when you see CDS blowing out like it was yesterday, that does create ripples. It creates a little bit of anxiety in the market, and so people take risk off, and so that does have a little bit of a cascading effect. And so that's really yesterday to me was about interest rates really coming off. The 2-year Treasury is down over 100 basis points over the past week. That is a significant shift in terms of thinking about one big variable of earnings. And then the other piece yesterday was just, credit is now, in the forefront, credit risk of companies, but also just, the economy arguably, getting tighter here as a result of what's happened over the past week. And that could lead to tougher economic conditions. And, financials are obviously, really in the forefront of that type of conversation. Again, the companies that manage well, have underwritten their balance sheets well, are going to take market share here and will come out. So there's going to be a lot of opportunities created, but you really need the dust to settle here before people can really, I think, have conviction in that.
Talk more about those opportunities that would be created. I mean, for some people who would think to themselves that the financial sector is untouchable as an investment right now, what would you say to that?
Yeah, well, I do think that you need to tread carefully. Again, the headlines and trying to keep up with where we are day to day here is really tough. And so, as I mentioned, people and institutional investors, that can trade the volatility are engaged, and ones that feel like there's just too much going on move to the sidelines. If you look at just valuations heading into even the past week, financial valuations were already reflecting, I think, concern around economic slowdown and some of these other kind of bigger macro issues. And so just one data point, financials, if you look at the bank index, it's trading at about 40% of the S&P 500's multiple. It's trading at like 7 times, 6-7 times forward earnings. Historically, it trades about 80% of the S&P 500 forward multiple. So even if you were to say that interest rates are going to come down. There could be some credit concerns, and you want to discount earnings to some degree. Valuations are very low. But again, I think that you really need to kind of see how the next week or two go here and be prudent around committing capital, because I think it's going to be very volatile with swings potentially up, but also swings down. And so I think investors need to be prudent and look at the safest and soundest companies in the space.
So Devin, just quickly, what are they? What are some of your favorites that you think are the safest and soundest in this environment?
Sure. I mean, I think that as we think about kind of where the business has evolved even over the last few days, trading activity is hanging in there, right? And so I look at a Goldman Sachs. Goldman Sachs stock is traded back down to about book value, 1x book value. And so Goldman, terrific risk managers. When you can buy it at book value, tends to work out long term. Again, near term is going to be volatile, but that's one we really like. In the mid-cap space, I would look at Stifel Financial, tickers SF. They have a very diversified business mix, so they benefit from higher interest rates. The first 100 basis points or so and lower rates really won't have that much of a negative implication. And then some of their other businesses, like trading, fixed income trading, will kick in. And so they've got a nice natural balance in their business. And then for folks that can take a little bit of a longer term perspective, some of the advisory boutiques that I cover, whether that be PJT Partners that has a great growth story, but then they also have a large restructuring business, which tends to be counter-cyclical and could pick up if the economy turns. That's one that long term I think could perform very well. Perella Weinberg is another advisory firm that has terrific long-term growth. So there is going to be companies that are negatively kind of caught up in this fear of the market, and their long-term business prospects have not changed at all. If not, some are even going to gain market share coming out of this. And so those are some of the areas we look at. There's obviously more. I think even in banks, there's going to be a lot of opportunities, but right now there's also still a lot of some of the moving parts of their models are moving pretty significantly right now.
And just a quick one about Schwab, Devin, because I know you just put out a note on that. That company in particular had seemed to draw investor scrutiny following the collapse of SVB. Was that scrutiny warranted? And do you think that's one of the ones where, I know you don't have an outperform on that one. I believe you have a market perform, but I'm curious how you're thinking about it.
Yeah, Julie, it's a great question. Schwab, the stock traded down about 40% over the past week to the lows and has since bounced off of that. I think people were getting confused around the issue there, and there's some misinformation that we were seeing in the market as well. To us, Schwab, there's no liquidity concern. The way they fund their balance sheet is from their brokerage business, and that's essentially cash that customers have in their brokerage account. Very, very different than in Silicon Valley. They do have a fair amount of fixed assets on their securities book, and so when rates move higher abruptly, that's not great for them. And so Schwab to us was really an earnings story, not a liquidity story. And when the stock was down 40%, people were kind of trying to frame it as a liquidity issue, which it really was not. And so we've been on the sidelines. Stock obviously had a nice bounce here off the low, and I look at the earnings profile and would say there's some more dislocated stocks in the market, but Schwab's a fantastic company. I think people were getting a little bit confused around how their bank works relative to some of the traditional banks, and particularly some of the ones that were having issues over the past week.
Devin, really helpful to take a step back here, take a breath after the past few days that we've had and get some perspective. Devin Ryan, JMP Securities, a Citizens Company Director of Financial Technology Research. Appreciate it.